Hey everybody, Jim Ingersoll here. Welcome back. It's good to see everybody again. You are in for an absolutely amazing show today with a guest I'm super excited to introduce you to and have with me. I've had a number of authors over the years, thinking back to Chris Voss from Never Split the Difference, The Go-Giver, Bob Berg, and others. But today is right up there on my list. I'm super excited to have George with me. We're going to dig deep into wealth building today, and in particular, one of my favorite aspects of real estate, which is leverage. And when you use leverage right, you can move from what George calls the left column to the right. But when you use it bad, when you use it wrong, you could lose everything. That's why I want you to lean in today, buckle up, and really pay attention closely to what we're going to teach you and what you're going to learn about today. You guys all know that I recommend you refinance, or rather you rehab your financing before you rehab a house. I recommend that you learn to use a financial calculator before you order your first dumpster. It's not like it is on HGTV, guys, and today we're going to explain to you how all of that works and why it's not complicated and why it's not hard. When you do it the right way, you're going to gain a lot. When you do it wrong, you're going to lose a lot. George Antone is the author of 3 of my favorite books. They're all best-selling books. You're going to have to check them out with the links below. He's a thought leader in the investing and in the finance space. And through his company, finance.com, and his community of finance hackers, George keeps developing new and innovative strategies that help bring people closer to their goals, that allow you to move from where you're at to where you want to go. And his upcoming project, investthen, is scheduled to launch later this year. I'm a fan of all 3 of your books, George. Welcome to the podcast today.
Thank you so much for having me, Jim. It's funny, when I first wrote my books, I've never enjoyed writing. And the fact, I told my wife at the time, I don't think anyone is ever going to read my books, but I'm just going to write them anyway. And I am blown away how many people really enjoy reading them. So it's just such a good feeling knowing that they're being read out there.
It is good. George, I've written 2 books myself, but your books are deeper than most books, in my opinion. They go a lot deeper into, and I love the way that you also inject the story at the beginning of the chapters.
Yeah, exactly.
I like that. I guess that's why I thought of Bob Berg a minute ago, because I had Bob on my show as well. Bob is a great storyteller, and you can learn through stories. So I love that you did that at the beginning of your chapters.
Yeah. Yeah, finance can be a boring topic, so I create some color there.
I love it. Well, let me start by reading just one paragraph from the Wealthy Code, okay? Because it leads right into leverage. And here's what you wrote. You said the fastest way to gain wealth is through leverage, the right kind of leverage. And the fastest way to lose wealth is also leverage, but the wrong kind of leverage. The problem today is that many people are using the wrong kind of leverage to build wealth, and they're setting themselves up to lose a lot of money. So I just want to lead in with that. What did you mean by that?
Jim, so as I study how the economy works, how things work, you realize that leverage, and specifically the right leverage, can build massive wealth for you. It can really improve your wealth, and you need it you need to understand it to build wealth. However, the wrong debt, having too much debt, or the wrong type of debt, which we can go into here in this podcast, can totally destroy people. So it's almost this double-edged sword. And one of the things that happened to me when I first started real estate was, 20 years ago, whatever it was, is I thought I was reading all these books on just use debt and go out and buy properties. And that's what's happening. A lot of investors just go out and say, let's just use as much debt as possible and let's just buy properties. And what they don't realize is that real estate isn't about the property. It's about a financing game. Yeah. And so what happens is they're like, let's just use as much debt as possible and buy properties. And that's exactly the problem, is they're not learning how to control this powerful tool that can destroy them. So there's many aspects to it, and people are just ignorant to it. So they're like, let's just go out and buy properties. So you have to learn how to manage it, how to measure it, how to use it, how to how to control it altogether. So, and that's what most investors are not doing.
Now, I know you wrote about leverage a lot in two of your books. Can you expand on sort of why that is so important that you wrote so much? Like in this book, you wrote a whole chapter on it. It's called, I love it. It's called Dissecting Leverage. So is it
Yeah,
that ultra important that investors get this piece correct?
absolutely. It is so critical to get right. So let's just expand on what I said. So debt, like I was saying, is so critical you get right. So you first need to understand it and understand all the different layers to that. Second, you need to measure it. You need to measure so many layers to it. We'll talk about the metrics here a little bit later if you want.
Yeah.
But there's so many metrics associated with debt that you have to measure it. And once you measure it, you have to be able to manage it. And what I mean by manage it is what happens, for example, when the market goes down, like it's about to happen, the recession. What happens if the market's going up? What happens if this and that? And you have to control and manage the debt as there's fluctuations in different different things out there, including the market. The other part is, how do you use it? I'm going to buy a property and it has certain characteristics. What do I do? How do I get the right debt? Because the debt on its own cannot exist. It is relative to the asset. And I can give examples a little bit later, but it is the matching of the asset and the debt that is so critical that most people are not getting. So I wrote these books to really help people understand all the nuances of leverage, because it's such a powerful tool and we need it to build wealth, but it can also destroy you if you're not careful.
And I think too, given our market conditions, all of a sudden we've got negative GDP, we're heading into a recession. Millions of people are filing for unemployment again this week. We still have a number of states that are in lockdown. That's the days of people just buying and speculating for real estate, taking on that debt and just like burying their heads in the sand is going to come back to bite them really hard, I think, right now. So do you agree, like given the market conditions we've got, that it's more important than ever that you manage this?
100%. 100%. And as we know, with real estate, it's a cyclical market. So you always have to know what to do in times like this, because it's just a matter of time. It's just cyclical. It's by nature.
Yes.
So you have to know before you buy what to do when it goes down. Not if it goes down, but when it goes down. So you have to have that. And I get my students learning that stuff so well, and they all know what to do now. And they're all already doing the right things, which we can talk about here. But it's really important that you know what to do before you get into real estate or buy the property.
Yeah, I like Stephen Covey too, and he always talks about like doing things with the end in mind. And I think it's important when we buy houses that you buy it that way, whether you're trying to back into financing or leveraging seller financing or other people's money. You should always know what that end game is, and that end can change as it is now. So how would you recommend investors sort of preparing for what's going to come? This could be turned into a tsunami of economic difficulties coming up ahead.
So here's what I tell my students to do when when the market is the way it is. The first thing to do is you need to increase liquidity. So the first thing is increase liquidity. That means if you can refinance existing properties with fixed interest rates, do that. And the reason fixed interest rates is because we're at the perfect time to lock in these low interest rates. Cash out and stay liquid right now. Okay, that's number one. Liquidity is critical. The second thing is, minimize your payments. So that means if you have a 15-year loan, get a 30-year loan. Lower your payments so that your overhead is lower. And there's a metric I'll talk about a little later if you want, called the loan constant. So you want to lower all your loan constants down as much as possible, so that this way you have nicer spreads, which again I'll expand here in a minute. But so first thing, liquidity. Second is minimize your payments. You lower your payments. The last thing is deleverage. Now, what I'm sharing with you here is part of deleverage, but deleverage is the most important thing that they have to understand how to do. And most people don't know what I'm talking about. So people think deleverage, that means pay down loan. That's not the case. The way it works is that there's a metric that people have to know called debt to asset ratio, which is at the portfolio level, not at the asset level. At the portfolio level, you have to measure how much debt you have in your portfolio. So debt to asset is nothing more than all your debt divided by all your assets. And I'm not talking about debt to income here. I'm talking about debt to assets. So all your debt on top and all your assets, including cash, in the bottom. That number is critical that you control. That number has to be 65% or lower. So what I tell my students is, in times like this, you want to take a defensive position. You want to lower your debt to asset ratio by some of the things we're talking about, increasing your primary reserves and doing certain things like equity shares and different things. But you want to lower your debt a little bit down to 45 to 55% and take a defensive position and get ready for what about to happen. So in what's happening now with this upcoming market, you have properties declining in price, you have fixed interest rates, lower interest rates, and so just by doing some things we talked about, it's the perfect market for a lot of real estate investors. Now, if someone doesn't have the liquidity, they need to learn a lot about equity financing, not debt financing. So they need to figure out what equity financing means, look into it, and study equity financing. This is the perfect time to be using equity financing in the upcoming market. That is critical.
Glad you brought that up. I love equity financing as well. I'm actually working on a digital product on joint ventures as we speak. I'm almost done with it. And it's all on equity financing because there's very few people that ever talk about it. So thank you for bringing that up.
It's a very important skill.
So looking back over the time, what do you think are 3 mistakes that you see investors making when they go into leverage the wrong way? What are some things that they do that you need to watch out for, like the blind spots?
So I'll tell you there are so many mistakes. I'll tell you the first one is, the first big one is investors look at the interest rate on the loan. And they say, okay, this interest rate here on this loan is 5%, this is 4.5%, therefore the 4.5% must be better than the 5%. That is the number one mistake. When it comes to cash flow or income producing assets, you have to look at a different metric called a loan constant. And a loan constant, I'll give everyone the formula here. It's nothing more than your monthly payment, the principal and interest, not the PITI, but just the principal and interest, times 12 gives you the annual payment, divided by the original loan amount, not the loan balance, but the original loan amount. That number needs to be low. That's more important for income producing assets than the interest rate. The interest rate comes after that. So what they want to do is pick the lowest loan constant, not the lowest interest rate. In fact, there's many deals out there where the interest rate is higher, but the loan constant is lower. For example, a 15-year loan versus a 30-year loan. A 15-year loan is a lower interest rate, but a higher loan constant. And most people say, you know what, I want to be debt-free in 15 years, and it's a lower interest rate, therefore I'm going to take that. What they don't realize is that the bank just shifted all the risk to them, and the bank is enticing them to pick that. So first mistake, don't just look at the interest rate, look at the loan constant on income-producing assets. Second thing is reserves. Anytime you use debt, reserves is part of the equation. You have to have reserves. And the number one thing I hear from most investors is, wait, that money is just sitting in a bank account doing nothing. So here's what I tell them, imagine we're building this 100-story building, right? And we build that whole thing with very strong foundation. And then one day we decide, you know what, we're done with this building and that foundation is underground doing nothing. Let's just suck it out and use it to build the next building, right? That foundation is reserves, and that building is your debt. So they need to use reserves and learn how to use reserves. with debt. It comes hand in hand. The other part is a lot of people use the wrong structure. And what I mean by that is a lot of people think that I can just use debt to buy the property. You have to match the debt to the property. It's a matter of matching them. So if you don't match them, it can be a problem. So here's what I mean by matching them is every single asset can be placed into one of 6 buckets. The buckets represent different types of assets. And so imagine you have a grid 3 across and 2, vertical. And I'm going into a lot of detail here, but I want to just give people a visual.
I like the visuals.
Yeah, so on top row, it says stable, and the bottom, volatile. And the 3 columns are income-only assets, growth assets, and both income and growth. So now you have a grid of 6 buckets. Most assets or all assets fit into one of those 6 buckets. Now, depending on which bucket it fits in, you have to pick the right type of debt. So for example, if it is growth-only asset, there is no income, you don't want to use regular debt. You might use accruing debt. So what you have to do is pick the right structure for the right type of asset. So we go into a lot of this detail, but that's the third mistake that most people do is they just pick any debt to buy the property. They're not matching it to the property.
Yeah, and I think sometimes they just take whatever they can sort of get. And
Exactly.
I love amortization too. I think it's a great tool that works while I'm sleeping. But I was thinking of the difference between a 15 and a 30. I can't get 30 because I'm on commercial loans. They're all 20, 25. But even the difference between a 15 and a 25 is a big difference.
Yep.
But you can take that 25, and if you've got excessive cash flow, you can pay a little extra every month, depending on the economic conditions, and you can still get it paid off easily in 15 with a lot less risk.
So I just want to expand what you just said. That's so true, Jim. And so in a market like this, that's where you would minimize the payment and just pay whatever is owed, and you wouldn't make additional payments. But for the people that have 15, they don't have that option. They're stuck with the higher payments. And so now it's a higher risk for them. And so they don't realize the importance of what you just said there. That is so critical.
Well, I'm glad you brought it up. You got me thinking about that. So isn't a lot of this stuff that you're talking about similar to what Robert Kiyosaki, who I happen to actually love, his book, Rich Dad, Poor Dad, really made an impact on me. Isn't that a lot of what he calls good debt anyways?
You know what? That's a great question. So Rich Dad, Poor Dad and Robert's books have really impacted my life in so many ways. And I highly, highly recommend every person read the books. However, what he was talking about is, now his books are really focused on mindset, and it really changed my mindset. Now, what he talks about good debt versus bad debt. Now, let me expand on good debt. His definition of good debt is so wide and so inclusive of all types of debt to buy properties. The problem is that if people are not careful, right, a 15-year loan can fit into, for example, that definition of good debt, but it's not the best debt. And so what I'm talking about is a small subset within good debt. So think of good debt as a big category of loans. And what I'm talking about, which I call strategic debt, is nothing more than a small subset that is so specific to types of debt. And so it's very, 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 very specific within that.
Okay. And along those lines, you mentioned earlier about metrics. I love metrics. I've got an engineering background back when I was in corporate America. So I love metrics and controlling stuff. What are some metrics that work really well for leverage?
So, so what I'm going to share with you now are some metrics to do with buy and hold, because they don't apply to, say, rehab or quick flips or whatever. So here are some metrics. The first one is for people to realize that every asset can only carry so much debt. So think of it as weights. You can only carry so much weight, and every asset can only carry so much debt. The first thing you have to do is figure out what is the maximum amount or percentage of debt this asset can carry, and you can always go up to the maximum or less. So once you know that, that's the first thing you have to do is measure that. So so you have to know that. Now, if you go above the maximum, you can offset that with more reserves. So the first one is, what percentage of debt can that asset carry? The second one is the loan constant. So your loan constant, again, that's your monthly payment. So principal and interest, not the T&I, the tax and insurance, but multiplied by 12, divide by the original loan amount. You want that to be as low as possible because that is a measure of risk. So when you compare, for example, a 15-year loan again and a 30-year loan, you see that loan constant is super low, but it might be a little bit higher interest rate, and that's fine. So the metric you want to use there is a loan constant. Measure it and pick the lowest one. The second thing is you want to use what's called positive leverage. Again, I'm going into a lot of specifics here. Positive leverage simply means this. I don't care what your loan constant is if it's higher than your cap rate. So you want the cap rate from the asset to be higher than the loan constant. In other words, here's the example. If I borrowed money from you, Jim, and my payment to you is $3, but I use your money to buy an asset that pays me $2. So I'm getting 2, but I'm paying you 3. I'm losing money. That's negative leverage. So you want to make sure you have positive leverage. And I'm not talking about positive cash flow here. You can still have positive cash flow with negative leverage. So the way we do that is we look at the cap rate from the asset and the loan constant from the debt and make sure that there's positive spread. So you want to make sure you look at those metrics there, okay? The other part is make sure it's fixed interest rate as much as possible. I can't stress that enough. Fixed interest rate for long-term buy and hold. Then you want to also make sure you match the exit strategy on the property with the term of the loan. You don't want to have a balloon that is in 5 years when your exit strategy is 10 years or whatever. So there's so many things about that. The other part is reserves. You want to make sure you have enough reserves, at least 3 months of reserves. Reserves is your debt service, your monthly debt service, plus your monthly expenses, add them up and then multiply by 3 at least, okay? And so you have to, so these are some of the metrics I really focus my students on. And so when they're looking at a deal, putting a deal together, they're looking at all of these metrics and make sure everything fits nicely.
I love it. This is a massive black swan event. It came in, just like that.
Yeah.
So, I mean, I understand that there are investors that weren't able to pivot quick enough and get cash reserves. But hopefully all of you guys that are listening today have been working on that for a couple of months now, because it is, as you see, all of you see, it's absolutely critical. And as far as like commercial loans, George made a great point on understanding when that renewal is. And it's sort of negotiable too, George, is what I find with mine anyways. Like some people will say, no, it's got a 3-year renewal, which is ridiculous. And others will say maybe 5, 7, or 10. But you need to know the details. Like you've got to do due diligence on your bank to really know those details. Because people don't. People come to me, George, and I'm sure you too. It's like, it's been 5 years, my renewal's coming up. What happens? They really just don't know that level of detail. So I'm really glad you brought that up as well.
So Jim,
Go ahead.
we call that, just to add to what you're saying, we call that a short fuse. A short fuse is when you have a loan that's due within 5 years or less, even like 2 years, 3 years. And the problem with most of these deals is you don't realize how fast time passes. Once you get the property and you've got that short fuse, you think, oh, 2, 3 years, I have time. You never know what the market's going to look like, right? When you decide to, refinance or whatever it is. So what Jim is saying is so critical, and you want to avoid short fuses as much as possible.
Great point. It also goes back into the whole discussion on equity financing and reducing risk. So, and that leads me to the last question. Like, people talk about leverage and they think about risk, and then they get really nervous, and then they end up not doing anything. So can you expand on that as far as how you manage risk when you're leveraging?
So that's a great question. I want to share one thing I learned from Kiyosaki that's very powerful. It's one of the many things I learned, is the difference between risk and risky. So risky, that means you don't have control over it. It's just something that's risky. So when we talk about leverage, we're not talking about something being risky unless you're not educated on it. You just go in blindly and just get debt. That is risky. But risk is something that you can measure and control. And so we're talking about here is, yes, adding debt to a deal increases what's called volatility or uncertainty. Now you can measure and you can mitigate that risk. How do you do it? First, you need to understand it. How does that work? The second thing is you need to measure it. So everything we just talked about, those metrics we talked about, is anytime you have too much debt, you offset it with having too much reserves. So if you go above the maximum, if you go above 80% LTV or whatever, you offset that risk by having more reserves. So you have to start understanding how to measure all of these things. So once you know how to measure it, just with some of the metrics we talked about right now you want to learn how to manage it. So manage it means, okay, now I have this debt and the market is crashing. What do I do? So we talked about the debt to asset ratio. You want to deleverage a little bit. You want to increase liquidity. And so what happens is, if you have to know what to do. So that's the managing part. So now you start to see here where we're controlling this thing called leverage that is incredible, powerful, but also can really hurt you. And then finally, how to use it. So use it is, I'm going to buy a property and it has certain characteristics. For example, the characteristics mean the income from this asset is not stable. It's unstable for the next 2 years until I get it stable, right? And so therefore, that means more reserves. So you have to match the type of debt and the characteristics of the deal to so this, now we're using debt in the most powerful way to do so much, but we are controlling the risk and the uncertainty of debt. So yes, debt can destroy you. It has risk, but we can control that risk by measuring it, managing it, and knowing what to do in certain times. So it can be managed, and it is not risky unless you're not educated on it and you don't have the background to understand it. That it becomes risky.
Well, I guess that's why you said the most important leverage is knowledge also. So
Absolutely, 100%.
Yeah, I love it.
100%.
All right, I got one question from Martine Jackson, who saw you speak at REI Black Book, and she's in my Facebook group, Real Estate Investor Network. Can we do that one question?
Sure.
Okay, it's sort of two-part, but she said, would you recommend a cash-out refinance of somebody's house for more than 80% these days?
Okay, so I'm going to give you, so here's what I would say. Anytime you go over 80%, you're increasing the uncertainty. So it depends what you do with the rest of the money. So if you take that money, now in this market, you have to have liquidity. So I'm fine if they increase that, take some cash out, but they have to know what to do with the money. So they can't just go out and spend it on paying credit cards right now. In this economy, in this upcoming recession, you have to keep it in reserves and use it to eventually acquire other assets that pay for this additional debt. So the way you offset that higher risk by going above 80 is by having more reserves. So as long as you put it in reserves and you know what to do with it, and eventually you can buy or acquire assets that are income producing that pay for this additional debt, that's fine. But if they're going to go out and blow it on buying a car, bad deal.
I know Martine wouldn't do that. Here's the other part of her question. She's 29, by the way, and doing really well. But she said, you can tell she's thinking. She said, would it be wise to take a HELOC for an additional 15 to 20% if you want to use it to pay down that first mortgage? It's an interesting concept.
Yeah, so that's something, she's referring to the master sweep account.
Yep.
So that actually is a great idea. So by going up to 80%, and then the additional would be a HELOC to use for that, that's perfect. However, in this market, I wouldn't pay down your mortgage. Liquidity is more critical. Now, one of the things that banks are afraid of in this economy. Whenever there's uncertainty, is banks might pull the line of credit. So you never know when they might pull the line of credit. That's the problem. So just know that a HELOC is better. But in this economy, if they pull the line of credit, you have a problem. So if you get a line of credit, you might want to consider taking it out and putting in reserves because banks are getting very, very, very uncomfortable with those lines of credit. So I will not be surprised if they pull that line of credit. So
yeah, I saw it
that's why
happen. I saw it happen in the last recession, and it reminds me of another book, Profit First, which is a good book. And there's a story in there about a business owner that had his $1 million line pulled, and he owed the full $1 million. That's an uncomfortable thing to go through. That's not good. So that's good tips from Martina. I appreciate that.
Yeah.
So we're out of time, but could you give us a little glimpse into what's coming with investthen?
So I've been working on after talking to so many tens of thousands of investors.
Yeah.
My background is in software. I used to work at Intuit on Quicken Financial Planner, a number of Intuit's products as a software developer. This was ages and ages ago, and I worked for other companies like Microsoft as a software developer. So in 2001, I walked away from that whole career, and I got into investing full time. And so now I'm finding my passion about combining these two things. I want to take everything I know, put it into tools where people can implement and have the software look at their deals. So I'm pretty excited about creating something that's never been done before, and which is taking things to a whole new level with investing, and trying to create things that there's an algorithm I've been working on that is phenomenal, and I'm a geek when it comes to these things. But I'd love to share it with everyone when it comes out later this year. But it's a tool, a software as a service, where you can put your deals and it can do some pretty amazing things for you and do a lot of the, I don't want to say thinking, but it looks at your deals and it allows you to do some pretty advanced stuff. I won't go into too much detail.
Well, I'm
but some
looking
of my
forward to
students are
getting
seeing
it.
it.
So you've got me hooked. I'm good.
It's incredible. There's nothing like it on the market. I'll just tell you that.
Right.
I've been working on the algorithm for 6 years.
Awesome. I can't wait. So if our listeners say they want to connect with you, is it best to just go through the finance.com website, or what's the best way? I'll include the links.
Yeah, they can if they're interested in the books, they can go to Amazon, or if they want to check out, they can go to finance is spelled with a quirky name, FYNANC.com, FYNANC.com. There's no E in finance at the end, and instead of the I, it's Y, so FYNANC.com. And if they want to know more about investthen and sort of get on the waiting list, I only have a landing page right now where they can sign up for wait for the product announcement. It's investthen.com. There's nothing there but just a sign up list, and we'll announce when things are. It's out. It's honestly, like, in times of crisis, people sit late. I deep dive into new projects, and it's been something that I'm literally day and night working on.
I'm going to sign up today. So thanks for the tip. And I've really enjoyed this, George. There's very few people that I can talk to in that level of depth on these topics of leverage and debt. So you've stimulated my brain as well. So thank you very much.
Jim, it's been an honor. Thank you so much for having me. I really appreciate it.
All right, George, all my best to you. Stay safe. And thanks for sharing your gifts today. You've helped a lot of people. I know, like in my real estate Facebook group, how many people are reading your books. And you guys need to read them. And you're probably going to want to read parts of them twice. I tell you, I read parts of them twice. They're very deep. So go get them and enjoy them. Connect with George. George, thanks for being my guest today.
Thank you so much, Jim.